Welcome to Market Catalysts. I'm Julie Hyman. We're 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, the stock rebound continues on Wall Street. We'll break down the outlook for stocks as the bulls return. Plus, we'll discuss the outlook for rate cuts and the future of the Fed as the White House nears the end of its search to replace Jay Powell. And we'll hone in on the health of the consumer, the outlook for holiday shopping, and which retailers could be poised to outperform. But first, let's take a look at the major averages here. As we are a little bit into the session, we've got the Dow rate rising by about 1/3 of 1%, about 160 points right now. The S&P 500 up by about 1/3, and the Nasdaq is up by about 1/4 of 1%. So modest gains that we're watching across the board. Of course, large cap tech continues to be in focus here. We've got a little bit of a mixed picture. Alphabet is now falling by 1%. Nvidia rising, so switching places from where they've been as of late. But overall, not huge moves that we're seeing ahead of the Thanksgiving holiday. And we've been watching the sectors closely. Today, we've got utilities and energy that are doing the best. But as we've been talking about, this quarter's been really interesting because consumer discretionary communications services have been lagging. And you've had healthcare and utilities, but far and away healthcare as the best performer. So that's a theme that we have been paying a lot of attention to over the course of the quarter as we've been watching the kind of sector rotation and the volatility in large cap tech. And finally, getting back to what we've been seeing in the bond market as well. Just want to check on the 10-year note here. Here's the year-to-date chart of that 10-year, 4.03%. So we've seen a decline in yields and sort of a little bit of volatility as of late as investors try to figure out, is there going to be a rate cut in December? And then what happens going into next year? So let's talk more about that debate and what the economy looks like for next year. Markets are continuing to price in a rate cut in December. And this is Bloomberg reports that Kevin Hassett has emerged as the frontrunner to be the next Fed chair to replace Jay Powell. Joining me now is Stephanie Roth, Wolfe Research Chief Economist. Stephanie, it's good to see you. You, like all of us, you're thinking about 2026. You're trying to figure out what the picture is going to look like here. And you guys are looking for kind of trend growth, if I'm not mistaken, in terms of GDP for 2026. So how do you think that's going to play out?
Yeah, so I mean, it should be a decent year. This year it's been slightly below trend. We should see a bit of a pickup, specifically heading into tax season, which is where you'll see some consumer benefits, which should help specifically the sort of mid to lower end consumer. So there should be a benefit there. Now, it's not going to be a very robust year, but it should be fairly decent, which is one where the Fed's likely to cut in December, and then they're probably going to be on hold for a little while because growth will be picking up. Inflation will be a bit elevated in Q1. So then we're talking about potential cuts kind of after the next Fed chair, once perhaps it's Hassett. Once he gets into position, then we're talking about potentially 2 more cuts. But it should be a decent year. Inflation should be decelerating, and consumers should be looking a little bit better than they've been.
Stephanie, how much of the gains in economic growth right now and then headed into next year is sort of related to AI, the spending on AI, what companies are doing around AI? How do we sort of quantify that?
Yeah, so we've looked at sort of the AI components within GDP, and our estimates suggest that it's currently on a level basis, the actual size of AI spending related to CapEx is about 1.5% of GDP. That compares to larger investment bubbles, which are 3.5% to 4.5% of GDP. So we're certainly not in bubble territory in terms of the level of investment. As for how much it's been contributing to the economy, our sense is it's boosted. It's kind of representing about 1/4 of the GDP growth that we're seeing. So certainly important. Not necessarily game-changing. You hear estimates out there that suggest it's about half of GDP growth. We don't think that's the case, certainly smaller than that, but also a fairly substantial portion of the growth that we've been seeing.
So even if it's not, huge, but it's still substantial, we talk a lot about how dependent the stock market is on the AI trade. We've talked less about how dependent the economy is on the AI trade. And so I wonder if you share any of the concerns out there about overinvestment and whether the AI part of the economy is a risk at the margin if it slows down.
Yeah, at the margin, it is a risk. Certainly if it slows down, because it has been an important driver of growth, if not the primary driver. However, it doesn't appear to be sort of in bubble or frothy territory. Of course, now we're starting to get to the phase where we're shifting more towards debt financed growth as opposed to it being mostly coming from cash flow. So of course that becomes incrementally more risky. But as of now, it doesn't appear to be something that we should be overly concerned about. The CapEx is likely to be fairly strong for 2026. Companies need to kind of race to the investment cycle. They don't want to be left behind. We don't really know the real benefits of AI from an economic perspective. That will take a lot longer to play out. So up until then, companies are going to just continue to invest until perhaps we realize they've invested too much, and then it might be at risk of bubble territory, but we are a ways away from that.
And Stephanie, let's talk a little bit more about the Federal Reserve and especially the outlook for leadership at the Federal Reserve. If it indeed is Kevin Hassett, or really even if it's anyone who this administration is going to nominate, presumably it'll be somebody who is more dovish here. Do you think is that sort of the base case here? And what does that mean for Fed policy?
Yeah, I mean, remember that it is a vote by committee. So our expectation is even if the chair is a little bit more dovish in nature, they will have to get everybody on board. And, that might be a little bit more difficult to do, especially in an environment where inflation is still remaining elevated and rates are closer to what FOMC members view as neutral. So now it's a little bit of an easy argument come for the December meeting because many Fed members believe that we're still in restrictive territory. But once you get closer to, call it, 3.25%, 3.5%, 3.75%, a lot of, the decision is a lot more difficult with each additional cut. So it will be more difficult for them to sort of jam more dovish policy through. So our expectation is they'll probably get another 2 cuts or so, and then that will probably be it.
Do you think that there are still concerns around credibility at the Fed, especially if it ends up being Hassett?
Maybe at the margin. I think, certainly those fears have died down to some extent, which is, of course, really positive. We were really concerned when Fed independence was being questioned. I think what we've seen since the Cook case came out is the Fed members have kind of come together. So specifically Bowman and Waller, they all kind of voted with the rest of the committee rather than dissenting, which would have been a signal that perhaps the Fed is fraying at the margin. But now it seems that the other members have been coming together. So I think it is a concern that's lingering, but it's certainly not as severe as what was earlier the case. So it seems that the risk of, say, in February when they have to renominate the regional Fed presidents, that the members will largely get on board rather than some sort of negative event where they have trouble getting through the regional Fed presidents.
Right. And Stephanie, I do want to ask you about the labor market, the job growth backdrop here. I'm encouraged to see your estimates that you're still looking for growth in jobs next year, not declines. And what do you think is going to sort of support that job growth?
Yeah, so our view is that you'll see a bit of a pickup, and specifically in the cyclical areas of the economy. So retail, finance, leisure, manufacturing could get a little bit better. So the areas that have gotten hurt this year, largely because of economic uncertainty and the slowdown that we've seen this year, if we just see a bottoming in growth and activity picking up a bit, our assumptions are that you'll see a pickup in a lot of those areas of hiring as well. So we're looking for job growth to average around 80,000 for 2026. That compares to the recent average that's closer to 70,000, if not 60,000 if you shorten the window. So our assumptions are that you'll see just a bit of a better hiring backdrop kind of across the board. This year you've gotten a big slowdown, partially because of immigration, partially because of AI, and then the big reason and the most important reason has just been the broad economic slowdown. And those headwinds will turn to marginal tailwinds next year.
Stephanie, great to see you. Happy Thanksgiving.
Happy Thanksgiving. Thanks for having me.
Coming up, the holiday shopping season proving to be more resilient than expected. We'll take a closer look at where consumers are spending money and how it differs by generation. That's next on Market Catalysts. A new holiday sentiment survey from PwC shows consumers are still spending despite signaling caution, and most of that spending will be done over the next few days, with 41% of people planning to do most of their holiday shopping between Thanksgiving and Cyber Monday. Joining me now, Ali Furman, PwC U.S. Consumer Markets Industry Leader. Ali, thank you so much for being here. I, for one, if I'm doing shopping over this holiday weekend, I will be doing it from my couch because, like, the trying to get a parking spot at the mall, forget about it. But talk to me about that timing of the cadence of when people expect to shop.
Absolutely. So we surveyed consumers first in the summer, the late summer, and then we surveyed again at the end of October. And what we now know is that about 29% of holiday budgets were already spent by November 1st.
Wow.
But that leaves quite a significant amount of budget left to spend. So 64% was not yet spent by November 1st. We think this 5-day frenzy between Black Friday and Cyber Monday might see some of the highest record spend we've seen during that window of holiday shopping.
And is that all driven by sales and people waiting for those discounts? Maybe they have their eye on an item and they're waiting for the price to drop?
We definitely have a more budget-conscious, value-oriented consumer than we've had in a very long time. And then we have that K-curve economy, where lower to middle end consumers are feeling particularly squeezed, higher end consumers continue to spend significantly. I think the top 10% of income earners are making up about 60% of all discretionary spend. So that's a big difference.
Yeah.
What we're seeing is, though, a resilient consumer across all income cohorts and all generations. So those lower end consumers, they're still spending about the same amount month over month. They're just trading down and trading off, and to your point, looking for those discounts. 75% are holding back on making a purchase until something goes on sale.
And the other thing that's really interesting to me is we just saw a really lousy consumer confidence report from the Conference Board. The other confidence numbers have not been great. But we always talk about that disconnect between spend and confidence. So how are you thinking about that as you look at these numbers?
Oh yeah, we call that the say-do gap. So since the pandemic, we've seen that say-do gap widen and widen and widen year over year. So what consumers tell us they plan to spend or how they're feeling versus what they actually do is very different. We're seeing the same thing this year. Back in the summer, they told us they plan to spend 5% less on holiday year over year. Now, we looked at actuals, and when you apply predictive analytics to actuals, we're now anticipating 3 to 4% more holiday spend year over year. So, classic say-do gap in action.
Right, although some of that has got to be inflation, one would think, too, from the prices going up in that 3 to 4%.
That's a really interesting point. So retailers pulled a lot of holiday inventory forward to mitigate tariffs. So while we are seeing inflation, I think the last CPI was around 3%, we are not yet seeing major impact of tariffs on classic holiday categories like apparel, electronics, beauty, and toys. So I think consumers are feeling more comfortable that they're going to get the deals on the things that they want to spend the most on this holiday season.
Interesting. Okay, I also want to talk about the differences between demographics, between ages in particular, because I thought this was really interesting that, the sort of youngest and oldest people plan to spend the most?
Yeah, let's talk about Gen Z, ages 13 to 29, average age 22, and baby boomers. Okay, Gen Z first. In the summer told us they were going to pull back the most on holiday spend, 23%. They were going to pull back year over year, which was significant because the year before they planned to spend 37% more. What's going on there is two things: a coming of age story. They have a lot more cost of living expenses, mortgages, children, et cetera. But also, it's a signal that retailers are not yet meeting their needs, particularly in store. This is a digitally native generation who loves shopping in stores. Their foot traffic in stores is increasing month over month, but their sales are not corresponding with that foot traffic increase. Great opportunity for retailers to capture their wallets on Black Friday. Limited drops, exclusivity, treasure hunts. These are all things that Gen Zers love, so that could probably help. Baby boomers tend to be the upholders of holiday tradition. So they're the ones who are going to make sure kids have gifts under the tree, that families gather together around a table for a home-cooked meal. And as we talked about the K-curve economy, with some of their family members potentially being squeezed, they're going to make up for that. So these are people that are frugal day to day, but are willing to splurge on things that spark joy.
Well, and they also have the highest proportion of money in the stock market.
Yes.
In the stock market, yes, we've had some recent turmoil, but by and large, it's been going up.
Yeah, they have the most significant ability to spend on discretionary purchases. Their mortgages are paid off.
Right.
They're retired. And like I said, they're frugal day to day, but they splurge on things that will spark joy and uphold family traditions.
That's interesting. All right, let's talk about the ones that are stuck in the middle. And I'm in this cohort, Gen X and millennials. What are we seeing in terms of that?
So Gen X and millennial, I would broadly categorize as planning flat spend year over year. Millennials, they have families, so they're going to spend on things that either relate to smart home items and me time. We're seeing a lot of purchases made around things like, red light, therapies, or do it at home spa type activities, or like Dyson air wraps, or a air fryer, things that make their lives easier and or give them some solace amongst their busy lives. Gen Xers, they do have a good amount of discretionary income. They're in their peak earning years. They're actually doing the most for the retail luxury segment. They're spending a lot in retail luxury. Think of them as wanting to spend more on nostalgic utility. So things like branded collectibles, hobby items, home improvement items. They're also very focused on experiences. So if you have a Gen Xer in your life, buying them a really exciting, maybe luxurious experience, that could work well for them.
Well, it's interesting. We were talking in the break, by the way, about collectibles, and we've been talking to various guests that we've had on recently about collectibles, and it seems like they're hot, whether we're talking about cards or little figures, little boo-boos, whatever. That seems like it's a hot gift.
It is a hot gift, particularly for Gen Z. So anything that goes viral on social media is something that they're going to be interested in. They're the fastest to adopt trends and the fastest to abandon trends. And when they see something online, they expect extremely fast social to shelf velocity. So, that's another opportunity for retailers to get things on the shelves or online faster once they see a trend go viral.
I'm laughing because I'm thinking about our kids and how we need to teach them a little more patience sometimes. But I'm also heartened by the red light therapy trend because my husband's into that. I'm glad he's not the only one.
He's not. It's catching on for sure.
Yeah, thanks so much, Allie. Appreciate it. And happy Thanksgiving.
Happy Thanksgiving.
Coming up, some of today's top trending tickers, plus what retailer is best poised for a turnaround in 2026.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation. Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to The Big Idea.
Welcome to Weird Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
Now time for some of today's trending tickers. We are watching Robinhood, Nutanix, and Zscaler. First up, Robinhood. The company is launching a futures and derivatives exchange with market maker Susquehanna. Robinhood's rolled out a series of new offerings in recent years designed to meet the needs of retail investors. This move continues the company's push into prediction markets. The new exchange expected to begin operations in 2026. Next is Nutanix. The cloud platform company cut its 2026 revenue forecast. It also forecast second quarter revenue below Wall Street expectations. JP Morgan analysts said delays in when the company recognizes revenue after booking are part of the reason for the revenue shortfall. They also note the results reflect a choppy macro backdrop. JP Morgan cut its price target to $65 from $78. And finally, Zscaler, the security software company, forecast annual revenue that was in line with estimates. Analysts noted that the results were solid, but the stock is under pressure today. Shares of the cybersecurity player had rallied more than 60% year to date, but they'd pulled back heading into this latest earnings report. We'll have more on the company's results this afternoon on Yahoo Finance with the CEO of Zscaler, Jay Chaudhry, always a favorite of ours, down by 11% though, the shares. A slew of retailers reported earnings this week ahead of the crucial holiday shopping season. Names like Urban Outfitters getting a bump. Performance in the sector has ranged widely year to date, with names like Ralph Lauren and TJX both up double digits. On the other hand, we've got Lululemon, which is one of the worst performing stocks in the S&P 500. As we head into the final stretch of 2025, I want to bring in Dana Telsey Advisory Group CEO and Chief Research Officer, for more on what to watch in the retail space. Dana, it's great to see you.
Thank you. Great to see you too. Thank you for having me, and happy Thanksgiving.
Happy Thanksgiving to you. It's great to catch up with you on retail because it has been this interesting sort of bifurcated market. There's so much dispersion within how these retailers have been doing. So big picture, what to you stands out in terms of what differentiates those that have been succeeding from those that have not?
I think there's a couple things. I think, first of all, product newness and innovation. What are you doing to show newness and innovation? What consumers don't have, they're putting in their closets or wearing on their feet. So that's one thing. Second thing is managing tariffs. We all know the headwinds that tariffs caused in April. And frankly, the surprise is that companies have been agile and adaptable in terms of managing their margins. And I think the other change out there is the bifurcation of the consumer. Value and innovation matter. You're seeing the lower to middle income consumer pressured. They're minding their dollars. The higher income is continuing to spend. The sequential improvement that we've seen in luxury has been impressive. But you know what? It never hurts to have cold weather, given the fact that seasonal changes create demand. And I think that's a little bit of what we've seen with some of these companies that have reported lately. And some of the positive surprises have been obviously the sequential improvement at Abercrombie was encouraging. Look at Urban Outfitters with the nearly 13% comp at the Urban Outfitters division. We know that on footwear, Steve Madden, the casual boots, we know that Birkenstock, there's still demand for. And it was a surprise, just the improvement at Kohl's, which could be a read across for Macy's coming up.
Interesting. Okay, so of the ones that you just noted, and maybe you have some more to add, who do you think is going to then win holiday from the criteria that you talked about?
I think winning at holiday, I think Abercrombie is going to win holiday. I think Steve Madden will win holiday. TJX on the off-pricer side, I think they're going to win holiday. I think Macy's is going to be a winner for holiday, given the newness they have, given the excitement and activation that they're delivering.
And kind of what, again, is it going to come down to not just the innovation, but also value? I mean, what is promotioning? What are sales going to look like through the holiday season?
We're looking for a 3.5% to 4.5% increase. The reason it is so wide is because of this bifurcation. We saw promotions start in October with Amazon Prime Day, but funny enough, as we're heading into Black Friday, the level of promotions, because we track it this year versus last year, is pretty much the same. For some, it's a little bit less, but what you're seeing from the consumers are waiting longer to get their value and deals. So we expect Black Friday, as always, is very important. And if you want to go in a store that's open tomorrow, at least here in the New York area, it's Aritzia. So anxious to be in the store tomorrow also.
That's good to know. Good tip there, Dana. We were just talking to a consumer analyst from PwC who talked about Gen Z in particular. The brands that are resonating are the ones that, have things quickly that they want, are jumping on trend, and also are getting them excited about being in store, because Gen Z likes to be in store and shopping. Of course, they're online native. Who do you think is doing the best at sort of capturing that? I mean, I imagine Abercrombie might be on that list too.
Yes, it is. You know who else is doing a good job at getting Gen Z in stores? I mean, Old Navy. Old Navy did their first designer collaboration with Anna Sui. It is a value offering, and they're getting some people in stores where traffic has improved. And I think the other thing out there in terms of who's getting people in stores, look at the collaborations that Abercrombie has done with the NFL. And did you see yesterday the announcement that the brand ambassador for American Eagle Outfitters is Martha Stewart because of the Gen Z affinity for Martha Stewart? So we're going to be watching that closely to watch their stores with that Martha Stewart brand ambassador.
That's so interesting, that sort of nostalgia. I mean, Anna Sui as well. Like, she's been around for a long time. So it's interesting to see those designers or figures sort of come back and resonate with that younger generation.
Yeah, what's old is new again.
I love that. And Dana, let's also talk about some of the retail turnarounds, because it's been an interesting year to see. You mentioned Kohl's. Target obviously has been struggling for a while. Gap had been struggling, seems to be getting its mojo back. So as you look into 26, who would you nominate as sort of most likely successful turnaround stories?
I want to see Victoria's Secret. I mean, we know that they just had an updated fashion show. We know that they're focusing definitely on enhancing pink. They're doing some remodeled stores. Let's see what they're going to deliver to continue to focus on being relevant to today's consumer. What's old is new again.
And then as we look into holiday and then into next year, are there particular trends that you are watching, apparel trends or elsewhere?
I think one of the things I'm watching, AI. I'm watching the influence of AI on discretionary names in the consumer sector. They've all begun to talk more about it and what the influence it could have, whether it's in personalization, curation, even localization. How do you make big seem small, that it's unique to you and distinct to you? I think AI is going to be a topic of conversation in 26 that we did not see in 2025.
And are we going to see all of these retailers sign deals with ChatGPT? I mean, that seems to be at least the preliminary trend.
I agree with you. I think we're going to see more of that.
Dana, great to see you. Thanks so much and happy Thanksgiving.
To you too. Thank you.
Thanks. Coming up, we'll zero in on Alphabet's recent rally and what that means for the broader tech trade, where investors can find opportunity. That's next on Market Catalyst.
Well, Google's recent rally has allowed the stock to outperform other big tech stocks like Nvidia, Microsoft, and Oracle. Stock is trading at a record high and closing in on a $4 trillion market cap after the successful launch of its new Gemini 3 AI model. Join me now on where Google stands in the AI arms race. We've got Brent Till, Jefferies senior analyst. Brent, always great to see you. So Alphabet, it's in the green again here today. We are nearing that $4 trillion market cap, Brent. Let's start with the latest news. We have the information reporting. Okay, Meta's in talks with Google to spend billions on Google's chips and its data centers. You cover both Alphabet and Meta. You like both those names, Brent. You saw that headline. You saw that report. What did you make of it?
I mean, it's good news for Google, but it's not the end all be all. Remember, everyone is using everyone else's stuff because there's such huge demand. NVIDIA can't actually fulfill all the demand that's needed. So I think no one wants reliance on one vendor, right? So you're going to see diversification where you can do it. Secondarily, right now, everyone's capacity constrained. We talked to Microsoft, Google, Amazon. Effectively, all their backlog numbers are way higher than the reported revenue numbers because they're booking deals that they can't actually fulfill right now. And so you're seeing bookings higher than the revenue because of the demand so high. So I think spreading and diversifying the risk to NVIDIA also, no one actually has enough demand. I think at the beginning of this, or enough supply, at the beginning of this entire movement, everyone felt like we would go to one cloud. We would not make the mistake we did in the cloud in the past cycle, which is spread all our workloads everywhere. And the same thing's happening because you don't want over-reliance and you want, effectively, you can't get enough supply. So you're having to go to multiple vendors right now. So I think, look, the news flow was incredibly negative at the beginning of the year on Google. Everyone thought they were left for dead when you think about the transition to AI from search, and they've done a fantastic job of navigating this. Recently, you've now seen the anti-NVIDIA trade, so everything that's in the NVIDIA camp goes down, and everything else in the Google camp goes up, and you've seen this. So right now we're in kind of the flavor of the week, if you will, which is Google's doing everything. There's nothing wrong. They can't make any mistakes. But that's kind of market we're in right now. I mean, honestly, I think Meta's a way better buy down here than chasing Google at current levels. But right now, investors, again, are just chasing the momentum.
Well, let me ask you, Brent, because we talked about Google chips, but I do because I have you here. I want your take on Gemini 3 as well. There was a lot of excitement there. I'm curious your take on that as a financial analyst. You know, I saw Salesforce, Mark Benioff, apparently now, Brent, he's a Gemini guy. He says not Chat GPT. What do you make of Gemini 3?
Look, I think there's going to be a world where we use multiple AI agents. So the topic that's happening in our work is it's not Gemini, it's not ChatGPT, it's not Perplexity. We're going to use multiple agents. We're not going to use just one. And I know that Benioff's excited. He's dropping S-bombs on X about how good it is. But I think ultimately the technologies across the platforms are just getting better and better as you use them every day. There are going to be multiple technologies you're going to use. And so we don't believe it's a vendor take all. We think there are going to be room for multiple agents. There's going to be room for multiple technology vendors. What we've been saying, though, is that effectively there's only a few companies that have the dollars, the capital, and the actual users to make this happen. And you can count on one hand how many vendors can do this, right? It's Google, Amazon, Microsoft, Oracle. There's only a few. And so what I would say is, for investors, you want to buy where the worst sentiment is. You don't want to chase the best sentiment, right? At the beginning of the year, Google had the worst sentiment, and look at the returns year to date. The worst sentiment now for investors to be buying into would be Meta and Oracle. These stocks literally go down every day, and the businesses aren't that bad. It's just the momentum chase to Google is now like, there's not that big a stair step in what's happened in the business. The business in terms of the fundamentals are operating almost the same level as they were operating at the beginning of the year. It's just the sentiment turned. So I don't think it matters about chips or Gemini or whatever. I think it's a collection of things that Google's doing well that everyone should stay focused. Again, nothing to take away. We are big fans. We would stay along Google. But again, I think what you've seen is an oversold sentiment on the other side of this AI trade where, 2 months ago, Meta and Oracle couldn't do anything wrong. And these stocks were up massively, and now they just fell out of the sky. And that, to me, is a signal that something's wrong. When our fundamental work is that there's only a handful of companies that make it, that's, to us, the signal where the buy signal is much stronger at Meta and Oracle. It's not as strong at Google.
On Oracle, Brent, since you bring it up, listen, that one, to your point, it has been whacked here. The team at CFRA, I see they did downgrade Oracle to hold, and they were talking about mounting debt concerns. They bring up what they say is heavy reliance on OpenAI. But I know you like this name, so I guess what is your reaction, your response to that?
They just told you what you know. We've known that for a long time. It's not like there's anything new in that statement. So when you look at, I think what Oracle is, if you look like the stock ran on the OpenAI deal, effectively the entire value of that transaction is now out of the market cap. It's like OpenAI didn't even exist. And the success of what is happening at Oracle is broader than just what happened at OpenAI. So I think investors, again, this is similar to when the excitement on where we're at in Google right now. It happened in Oracle recently, where everyone's like out of their mind, like, oh my gosh, Oracle's winning everything, everyone else is dead, the whole AI trade's over, they're winning share, look at the numbers, Microsoft's done. You're like, this is crazy talk. Like, it's totally crazy. Yes, they have debt. Everyone knows they have a debt is part of their business model. But what I think they've been saying is that they've got great cash flow. They're not getting these AI deals from the lowest rung vendors. They're getting from the highest quality vendors. And so I think this kind of fear of being able to pay the bill is well embedded in the stock. So if an OpenAI comes out and says, look, we are fully good and we are fully endorsed on this contract and we don't have a funding issue, and we get some other clarification that Oracle's winning other deals beyond just OpenAI, which we believe they are, and they've said they are. Once they put those numbers up in early December when they report, I think hopefully the bleeding in the stock can stop. But right now, it's been like yelling into the wind on Oracle. No one cares because it's effectively, there's an engine out at Oracle, engine out at Meta, and everyone cares. That's all we want to do is talk about Google. Google's a phenomenal company. But I'm telling you, the same thing happened at the beginning of the year with institutional investors. They could care less about Google. Most investors were underweight the stock, and things flip. And so my point is, like, I think things are going to flip back on Oracle. We think they flip back on Meta. And for patient long-term investors, this is an amazing opportunity to buy these names. These have gotten oversold.
Coming up, we'll discuss why it's time to show some love to diversification in your portfolio. Stay tuned. You're watching Market Catalysts. Investors, of course, have piled into tech stocks this year. One of the best performers of the last month has been the healthcare sector, despite seeing little ETF flows. So it could now be the time to diversify your portfolio through ETFs. With us to discuss, Todd Stone, Strategic Securities Senior ETF and Technical Strategist for this week's ETF report, brought to you by Invesco QQQ. Todd's in studio with me, which I'm excited about. I'm an avid reader of your notes, so it's fun to have you here to talk about
Likewise.
this. So let's talk about this diversification thing. Like, everybody who comes on here says everybody has to diversify. It shouldn't just be all about tech. But is that actually happening?
Not by our work and our conversations, right? So if you think about the backdrop for the last couple of months, you've had a rush into AI type plays. You have 10 stocks that are 40% of the S&P 500. Tech is 35 to 36%, right? Those are all 60 to 70-year highs. You now have flows into the overall ETF spectrum really accelerating. So there's an embracement of the rally going on. All benefiting investors, that's great. But I think it's a great time, especially at the end of the year, to say, okay, how much exposure to AI do I really have? Because if I own the S&P and large cap growth and a thematic AI fund, that's a lot of the similar names. So I think when you look at flows to other categories, especially you mentioned healthcare or defensive type names, it's been dormant. And I'm not saying you don't want to go overweight those areas, but at least add some into the future. Small caps are the same idea. There's been outflows from small caps this year. No one wants any piece of them.
No, explain something to me, because healthcare has performed well. The price action has been positive this quarter and this month. So sometimes when we talk about ETFs and we're talking about flows that don't necessarily match price, explain to people how that can happen.
So flows are a great barometer, or a temperature barometer of investor behavior. So you can have an ETF rise, a stock rise, without the endorsement of flows, right? There's plenty of other players in the market pools. But so when I see healthcare starting to improve, and I also line it up with performance that's frankly been awful over the last few years, and I see outflows, that tells me it's ice cold, and if I wanted to be a contrarian and try to diversify the portfolios, that's where to start hunting. And now you're starting to see that manifest. I think there's a pretty good catch-up trade here. But going back to your question, again, it's all about the temperature towards sectors. It's very hot towards tech, ice cold versus healthcare.
Let's also talk about leverage in the market as expressed through ETFs, because when we talk about, is there a bubble? Are there areas of over exuberance and areas of risk? We tend to look at leverage. So what is that telling us?
So levered ETFs really came into vogue in 2020, right? Markets, economy shuts down, people are getting stimulus, markets go straight up, people use leverage. I think if you're looking for a barometer that tells you how over-enthusiastic people are, it's the levered ETF space, right? And that's part of the being in a bull market. But when you look at the ratio of assets in levered ETFs versus inverse ETFs, those are the ones that are going to go short, that's at about a 12-to-1 ratio. It's the highest in our data set.
So people are going much more long than they're going short.
They are not seeking out protection, right? Whether it's through hedging or option strategies. And that tells us just to be a pinch mindful heading into 2026, especially given the concentration that's going on there. So I would love to see that reset. You've seen some pockets, like the quantum area, reset a little bit, but it's not been a wholesale reset for a lot of corners. It would be painful, but I almost think necessary too for the durability of a bull market.
I mean, that also means, though, that when we do see these pullbacks, those people are feeling a lot more pain.
Oh, absolutely. I mean,
and then does that then trigger other behavior? I mean, you had, for example, Bill Ackman the other day saying, well, my investors in Fannie and Freddie are also invested in crypto, and they're having to cover their crypto and sell Fannie and Freddie as a result. So, like, you see these unexpected knock-on effects.
It creates a source of funds, right? If I have a position in crypto or some of the more speculative high beta areas and I need to sell something, it's going to be that, and that can create a feedback loop that echoes throughout the markets. You haven't necessarily seen it from the mega cap names and through the cap weight indices, but other corners have definitely taken a hit over the last month or two. So do they bounce back? We'll see, but I think that's, I would really keep an eye on the leverage space because that's where a lot of the enthusiastic behavior is.
And then I do want to ask quickly about crypto specifically, right? Because it is such a new space, but such a huge space already.
Right.
What stands out to you that could indicate what may come next?
So I think crypto is toying this line between mass enthusiasm because it's a new area, right? You're seeing all sorts of crypto ETFs come out, and then mass adoption because it's rare you have a new asset class available to the mass community of investors. I got a little bit deterred by the amount of product that was coming out recently, right? You look at ETF launches, investors want to go what's hot. And when I start to see altcoins and stuff that frankly none of us really know about, that creates a backdrop of, hey, just be careful here. I think in the near term, Bitcoin's a little bit oversold. Can you see it bounce? Yes, but I wonder if risk is off the table right now for crypto, just given how enthusiastic folks got in terms of these launches.
Yeah, maybe a little bit over enthusiastic. Yeah. All right, Todd, thank you so much for coming in. Appreciate it. Happy Thanksgiving.
You too.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here today, we have a rally that is holding on and actually extending a little bit. We've got all three major averages up by at least 2/3 of 1% here. It's sort of a mixed picture within the components of the NASDAQ 100, but overall, we're seeing some pretty solid gains here after some recent turbulence. But there is one big tech stock that is not doing as well. That's HP. It's falling after the company announced it plans to cut up to 6,000 jobs due to AI after its profit outlook fell short of estimates. The company's CEO says the cuts will result in $1 billion worth of savings. Joining me now, Wamsi Mohan, BofA Securities Senior IT Hardware Analyst. Wamsi, it's good to see you. Thanks for being here. The memory chip problem seems to be an issue that is now sort of rearing its head, and that is memory chip prices are going higher, and this is proving to be a challenge for HP and others. So they're sort of looking for ways to save. Do you think that's sort of the primary challenge going on right now for HP?
Yeah, Julie, thanks for having me. Look, I'd say that HP has sort of faced a challenge of the print business where it's very profitable, but has been a slow to no growth kind of business. And then you have the PC business that goes through cycles, and they benefited from some of the growth that you saw because of Win 11 refresh and things like that. And now you're heading into a point where PC growth in itself is slowing down a little bit because of tough compares. Print is still a little bit challenged. At the same time, you've got this commodity price pressure that's weighing on margins. And so to offset that, what HP and other companies are taking a lot of actions, including OPEX savings through whether it be through layoffs or through a lot of other actions that they can take within their portfolio. And then they're leaning heavily into the supply chain to make sure that they can procure maybe lower cost components at certain places where they might be able to sell product that might be maybe cheaper memory that might be coming from China, as an example, right? Or other areas within the supply chain. And these companies work really hard to figure out like every penny of savings when you're shipping so many millions of PCs. You can definitely find areas to be creative within your bill of materials. You can de-spec some of the PCs and like less rich configurations. You can adjust pricing. So the whole swath of things that you can actually use to be able to offset some of the pricing pressure. But again, like the reality is memory pricing has gone up tremendously in a very short period of time, and that creates a lot of volatility.
And Wamsi, when a company like HP, like we've been hearing from a lot of companies saying they're going to do some job cuts over the coming years, and they talk about it that they're going to leverage AI in order to enable that. Is that really about AI, or is it about the company just needing to save money and sort of finding ways to do that? And AI is the freshest way to be able to do that.
Yeah, it's a great question. Look, I mean, I think that if you look at the way in which a lot of companies are approaching AI, and we have a perspective on sort of how AI rolls out across enterprises, right? The very first thing is on ROI. When you look at it from a 2-year time frame, if you're investing in AI, you're trying to make cost saves, you're trying to automate back-end processes, you're trying to take what can be very programmatic in some jobs and say, well, I don't really need a person, I can automate this process. And so we're sort of going through that phase where a lot of companies are trying to take the most automatable pieces of their business workflows and leverage AI to do that. Now, as you're seeing that go across enterprises, you are seeing more and more news of layoffs. Now, that's partially the case for HP. I'm sure that they're leveraging AI in a lot of different ways to be able to do that. But I think then you have to face the reality of the market, which is that the market's not a very high growth market. And so you have to bake in, if you're EBIT is going to be shrinking over time, you have to find other offsets to be able to offset that. And so they've done a pretty good job at being able to deliver stable earnings and stable cash flows. And they're promising to get roughly free cash flow year on year, despite the fact that they have all these challenges, both with memory and with supply chain. So in some ways, they have to do what they have to do to manage their cost structure in a low growth to no growth business. But at the same time, AI is a productivity tool that enterprises beyond HP are also using very effectively to be able to automate and take some of the cost out, which can then be redeployed in other areas of investment for growth. And HP is doing that too.
Well, and I'm curious, Wamsi, these folks who are going to be let go, not just at HP, but sort of across the industry, will there be other places picking them up, right? Will there be that absorption of hiring? And if not, are we going to have a bunch of sort of tech industry refugees, so to speak?
Yeah, it's a great question, and it's a difficult one because in some ways, right, like in past cycles, when you've seen productivity improvements, that has been an avenue to say, well, like, we're driving productivity in one place, well, what happens to the people that are being let go? And it's a difficult question because the skill set might not match immediately with the potential opportunities that would be created downstream. So AI would be a net productivity booster, in our opinion, where there are more jobs and opportunities that are created because of AI in the future, because you are now able to manage your time differently. You're able to do other productive things more easily and more productively. And so it frees up time and frees up time to higher level things. You might not spend as much time on mundane things. And so it depends on the skill set of the person, I think, where if you retrain in other areas, you might be able to go to other areas more easily. And in some cases, it's just going to be tougher to find an equivalent type of job because those jobs are getting automated. Right. So it does involve retraining. It does involve sort of reskilling of sorts that is absolutely essential. And you're seeing that not just in the layoffs, but even in new grad hires and data that you look at. It's just the very low level kind of maybe entry level jobs that don't require a lot of experience or sophistication in some ways. Those are the areas that are first being challenged by AI. Now, you do need human oversight, and there is a theory that the organization structure is going to change over time, right? Like you have had these kind of pyramid structures for a very long period of time, and with AI, maybe you don't need as much of the workforce at the bottom, but you need more of a workforce in the middle to manage these AI sort of, either workers or agentic workflows as you may. If you think about that, the organization structure could become more of a diamond structure where you don't have as many people at the bottom, but you have more people in the middle that now are reskilled to actually manage and make sure whatever the AI is doing is really what you want it to do.
Yeah, of course, the problem is if you don't have as many people at the bottom and you need a lot of people here, where are you getting them from? But that's not a today problem, Wamsi. I want to get in Dell as well. You're more of a bull on Dell. You've got a buy rating on that one. It's been easier to be a bull on Dell. It's done better. And this report shows once again that it is benefiting from the demand for AI servers. So what's your read on the quarter and also the forecast?
Yeah, no, it's really interesting. I mean, HP was in a unique position where they had to they finished their fiscal fourth quarter and had to give a full year outlook, and that included the impact of memory pricing. And Dell has still got another quarter to go before they're in that situation to give you a full guide. But they did give you some tea leaves around how to think about next year, which is very consistent with the way that they articulated at their analyst days, which is, think about 15% EPS growth roughly in that range as a good starting point. So they reiterated that despite the pressure. So HP did cut numbers by about 30 cents or so from a perspective of the headwinds that they're going to get from memory pricing. Dell really didn't articulate it in the same way. And now one of the things that you have to give Dell a lot of credit here is that they manage their supply chain extremely, extremely efficiently. And not just that, just because of the process by which they go to market, right? So you have a direct business. As you get customers on their side trying to configure a PC, they have a lot of choices to shape the demand. It can be based on the inventory that they have. They can price differentially and maybe sometimes close the gap or narrowed or widen the gap between one configuration to the next to be able to move customers one way or the other. And this is really important to manage the supply chain. And they're much more real time in managing the supply chain. So in some ways, Dell is showing yet again that they have the capability to flex this supply chain muscle and be able to navigate extremely difficult market environments. And we saw this during COVID. We saw it even in 2017 when memory pricing went up. And so they've had a history of managing the supply chain extremely well. And we're very bullish about the fact that they have been able to continue to navigate and give people the confidence that they can continue to navigate even in the future. From the quarter itself, one thing's very clear, right? AI demand remains very, very strong. They moved up their guidance for AI revenues from 20 billion to 25 billion for this fiscal year, which ends in January. But when you look out to next year, I think they're in a position where they could even double their AI revenues. And this is going from, barely anything 2 years ago to $25 billion this year, going to potentially $50 billion next year. And so I think the very interesting thing that Dell is, the interesting position that Dell finds itself in is that the market is moving squarely in the direction in which Dell's strengths are, which are AI servers. It's about storage and changing the enterprise data architecture. It's about AI PCs, which will become more of a thing as you get potentially differential pricing in the way the software is priced on the cloud versus on device. And you have a great cash conversion cycle, and they're managing the supply chain. So yes, we continue to be very, very bullish about Dell.
Wamsi, big prediction there, doubling in AI revenue next year. We'll keep an eye on it. Thank you so much for joining us, and have a great holiday.
You too. Happy Thanksgiving.
Thanks. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Many companies are already offering Black Friday and Cyber Monday deals to shoppers at a time when consumer confidence is falling. One company that helps connect businesses with consumers is Klaviyo, which works with 186,000 brands. For more insight into the state of the consumer, we're joined by Andrew Bielecki, Klaviyo CEO. Thanks so much for being here, Andrew.
Yeah, thanks for having us.
So that's a lot of brands that you guys represent. So I'm curious what you're seeing in terms of how they're reaching out to consumers ahead of this holiday. And I imagine part of that has to do with a lot of sales and deals and promotions that they're offering.
Yeah, so as Klaviyo, like you said, we serve over 180,000 businesses, household names like Mattel, Glossier, Away, Liquid Death. And we offer them a CRM to connect with their customers. So both marketing, proactive messaging, and also customer service. So when somebody comes and has a question, maybe is looking for holiday advice, we offer that up too. We're seeing three big trends from consumers so far. The first is the holiday season is already well underway. Shoppers are shopping early. We think more than half of shoppers are actually planning to buy before even Thanksgiving. So in some sense, those Black Friday, Cyber Monday sales are already going. The second is that a trend we've seen over the last couple of years is an increasing number of consumers are going back to businesses they already know when it comes to the holiday season. And we're seeing that actually up a lot this year. In November, we're seeing repeat purchases up 17% relative to last year. And that's actually ahead of where new buyers are. So a lot less of us we're going back to the things we know versus trying out new products or new companies. And then finally, the experience of shopping, people expect more. We're seeing over 35% more product views from consumers before buying. So they're browsing longer, they're checking out those features and those specs before they make their decisions.
And Andrew, I'm curious how your clients are communicating with people. I mean, we've been having a lot of holiday shopping conversations here on Yahoo Finance, and I keep hearing, one of the themes I keep hearing over and over again is that people are going to be using generative AI to help in their shopping journeys, whether it's asking for advice, whether it's saying here's my budget, tell me, what I should be getting. And so are you helping brands sort of meet them there, or, how is that all sort of playing out?
Yeah, I'll give you two great examples from our customers. The first is Beyond Yoga. They're an amazing athletic apparel company. They're using a customer agent technology that we provide that's on their website. So when you're going and shopping for maybe that, yoga lover practitioner in your house, and you need to find that perfect gift, that customer agent is able to have a conversation with you about their product catalog, maybe what your budget is, and help you find that product. So I think some of the things that as consumers we've seen with, say ChatGPT, with Gemini, that same technology is now coming to every single brand. The analogy we make is it's a bit like the 90s where, Amazon came about and then all of a sudden everybody needed a website. I think now everybody needs their own customer agent to help customers, guide them in the buying process. And then businesses are taking the data that they already have about customers and they're building that into marketing using AI. So another one of our customers, ButcherBox, I think they're shipping something like 200,000 turkeys, to families across the U.S. This Thanksgiving. They've had these customers that they've been learning about throughout the year, and they're learning all about their preferences, what cuts of meat beyond, just turkeys or hams for the holiday they like. And they're building that into the messaging, they're sending over the holiday season, because a lot of people will buy for the first time, through ButcherBox. And then if they want to get them into, to be a recurring customer, they're using that to tailor that experience. So AI is very plentiful in like the marketing and service experiences that folks are offering.
It's in those services, but I also wonder, how concerned you are about your business that people are just going to go straight to ChatGPT and they're not going to need that sort of liaison, if you will, between the brand and the customer that you guys provide.
Yeah, no, what we're seeing is that, similar to what I mentioned, is AI is becoming something that, consumers are using in their everyday lives to start, search, and find businesses. And so we're actually seeing a lot of our customers are getting increasing demand for their products. They're finding more consumers that then they'll, message and build experience around through Klaviyo from ChatGPT and other, AI products. But then really those businesses understand the experience that consumers expect is going up. I think the days of retailers just offering products and they sort of sit on the shelves and, you as a consumer have to figure out what you want. Those days are coming to an end. And now people expect to be guided. And that's happening through AI. And so they're turning to companies, like Klaviyo to deliver that, across all of the different customer touch points, marketing, service, their website, and even in some like physical retail stores.
And how are you thinking about also, helping customers with the website in a way that AI finds the information that it needs, right? Do companies need to redesign their websites to sort of cater to that?
Yeah, it's a great question. Well, there's two things that we're doing that I think are very interesting. So some of the companies that I mentioned, one, our customer agent for companies like Beyond Yoga, it's just on your website. Actually, we're sort of making this idea of a customer agent or service more plentiful. So instead of having it hidden behind a 1-800 number, you have to wait on hold, or it's sort of hard to find. Like, actually, you can put customer agents out front, and because they're so cost effective to serve and they help improve the customer experience so much, people want to get them in front of customers, give people an alternative way to buy. And the second part is we have a product called Customer Hub that you can imagine when you're browsing a lot of retail sites, oftentimes they don't know who you are. With our Customer Hub product, you can, log in and share some of your preferences with that brand, or maybe that brand already knows you. You can remind them who you are. And then it completely tailors the experience to you. So it'll show product recommendations that we've computed based on browsing activity, past purchases. So AI is really starting to get woven into the entire customer experience. From the site, across all of the different, services and touch points.
Andrew, thanks so much for joining us. Have a great holiday.
Yeah, thanks.
Coming up, there is nothing small about Small Business Saturday. We'll discuss why the Saturday after Thanksgiving is so important to Main Street. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Campbell's Soup, Scripps, and Petco. First up, Campbell's Soup. The company is taking action following widespread backlash to a lawsuit alleging that an employee there criticized its products and made racist remarks. Campbell said today the employee at the core of the lawsuit has been placed on leave as the company investigates his comments. The VP of Information Technology allegedly said the company's food was for, quote, poor people, and referred to his Indian co-workers as, quote, idiots. Campbell's is also facing widespread criticism online following those alleged remarks, with many threatening to boycott its goods. Next up is Scripps, the broadcaster adopting a so-called poison pill to thwart an unsolicited takeover by rival Sinclair. Earlier this week, Sinclair offered to buy Scripps for $7 a share in cash and stock. After Sinclair's disclosure, Scripps said its board would take all steps appropriate to protect the company and its shareholders from the, quote, opportunistic actions of Sinclair or anyone else. A poison pill is a defense strategy that a board of directors may use to try to keep control when a public company experiences an unwelcome takeover bid. The most common poison pill is the flip-in, which involves issuing more shares to shareholders, excluding the entity angling for control. You've got Scripps shares down a bit today, Sinclair trading a bit higher. And finally, Petco, those shares are jumping as the pet retailer raised its full-year earnings forecast. The latest figures signal its turnaround is gaining traction. CEO Joel Anderson joined the company in 2024. He introduced new executives across all areas of the business. Anderson said rebuilding the base of Petco's economic model has been the company's priority this year. Investors appear to be rewarding those efforts today, with the shares up 15%. Well, sentiment among small business owners fell in October, due in part to a drop in third quarter profits, plus higher materials costs. And for businesses along Main Street that employ nearly half of the U.S. workforce, the holiday shopping season can be make or break for their bottom line. Joining me now is Elizabeth Gore, co-founder and president of Hello Alice, and host of the Yahoo Finance podcast, The Big Idea, to discuss the importance of Small Business Saturday. Great to see you, Elizabeth.
Howdy. Happy Thanksgiving.
Happy Thanksgiving to you. So Small Business Saturday has been around for a while now. How much of a driver is it for traffic into these stores? I mean, how successful has it been in sort of raising awareness and getting people to shop small?
Oh, it's enormous. I mean, the fact that you're talking about it, of the 86 million shoppers that are going to hit the streets between Thanksgiving and Cyber Monday, our vast majority of those hopefully are going to walk into stores that they love on the corner. Main Street really thrives during Small Business Saturday. And as you said, small business sentiment has been unusually low lately with the high cost of capital and waiting on the tariffs argument from SCOTUS. But you're also seeing that they are the most trusted group in America, which means folks are walking in, buying those toys, all those things that you love for their families. So it's a critical time for small business.
So when so much is riding on the line here for many of these small businesses, Elizabeth, what do they need to do to make sure that they're capitalizing on it, that they're getting people in the door, and that, you know, they can remain in the black this holiday season?
Well, I love the campaigns you see. I mean, Good Foods Family, they are a cranberry company that's trying to beat out ocean spray for the first time. So it's going viral right now. You see superstars like Kristen Bell. All her shopping right now is going not just with small businesses, but she's donating all proceeds to Hello Alice grants with small businesses. They're also utilizing new software and AI, as you said before. PayPal's new program, Buy Now, Pay Later, is a big one for small business owners to allow shoppers to walk in, make that purchase without worry. So I also am really excited to see groups like Amazon promoting small business. So you can go on and click just the small business sellers button. So even if you're not leaving your house, you're still supporting small business.
And that's interesting, too, because I think now in some ways it's harder than ever to find those small businesses. In some ways it's easier than ever, right? In other words, you know, we've sort of seen the franchiseification of a lot of main streets across the country. But as you say, you're also seeing an increase in accessibility to these small businesses online. So if I'm a shopper, like, what is the best ways to find these small businesses if I want to patronize them?
Oh, I'm so excited about, as y'all were saying earlier, AI. Just jump into your chat GPT. And if you want to do it from a geographic standpoint, if you're in LA and you're looking for pretzels, you'll probably find Shappy's Pretzels. If you are in New York and you're saying, what are the best baked goods? Put that in there. In New York City's and Baked by Melissa is going to pop up. So it actually should be easier than ever. Also, most small businesses are also shipping, which is an exciting time. It's getting easier, particularly with their own stores and things like Shopify, for them to ship out. So you should be able, and even now you can say, hey, I want small business and I want veteran owned. So you can do a double search for your community and give back to those who are employing your friends, your neighbors, your cousins, and everyone you love.
And how are these small businesses navigating the tariff and inventory situation right now, right? And making sure they've got enough inventory in their stores heading into this holiday weekend?
You know, since COVID, this is the toughest time for supply chain. Part of that is still coming out of the tariffs issue. As I said earlier, folks are waiting on that SCOTUS argument to see if tariffs are going to stand. It depends on where they've diversified, where they're getting their items. If they're in one country and those tariffs are high, they've had to wait. Now, some small businesses have stocked up and tried to keep things local, so they're not having to pay those high prices, but ultimately, it will be passed on to the consumer. And I just ask for consumer patience, because your bakery does need to pass along that cost to stay alive.
And Elizabeth, of course, it's not just about shopping for gifts for the holiday. Thanksgiving is tomorrow. You mentioned that cranberry company. And so how should people thinking about for Thanksgiving itself, maybe shopping small? I mean, most people, for example, buy their groceries in big stores, but not everybody. You know, you can go to your local butcher, et cetera. So how can people sort of strategize to help small businesses and to shop local, you know, at that time as well?
Yeah, well, you know, the vast majority actually of food production and groceries are still small and grocers in this country. So you can really make an effort to do that. As I said earlier, you can actually go online still as of right now and buy products and have them shipped to your house by small business companies. That is a way to do it. Even go down and think about the corner store and buying some of your wares, some of your plates from that local store. This is what you can do. Those of you who are like me and don't cook a lot, if you want a local caterer, think about that. You're really going to benefit those small businesses.
Elizabeth, great to see you. Have a great holiday.
Happy Thanksgiving.
Thank you. And be sure, of course, to listen to Elizabeth each week on the Yahoo Finance podcast, The Big Idea, on Thursdays at 3 p.m. Eastern, where she talks about all of these issues facing small businesses. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
All right, 'tis the holiday season. That means potentially a new computer or a new printer under that tree. To that end, let's bring in HP CEO Enrique Lores, fresh off his earnings release. Enrique, happy holidays to you and yours. Good to see you as always. Your biggest takeaway for this quarter?
First of all, thank you for having me here. And as you said, holidays are coming. Why not both, a PC and a printer under the tree? But let me go to Q4. We had a strong Q4. The company grew for the 6th consecutive quarter. We also closed the year with positive growth, and we end the year with good momentum, especially in the PC side, both in commercial and also in the consumer side. So it was a good quarter, Brian.
There is, I don't know, I'm going to call it a crisis, because that is what other people are calling it in the industry. This memory chip crisis. There's so much demand for all things AI. It's causing shortages in chips. Prices are going up. You know, I was reading some research from Counterpoint Research. Memory chip prices up 30% expected in the fourth quarter. Another potential 20% increase next year. What is happening out there, and how are you responding?
Well, first of all, you summarized it well. There is a lot of demand for memory driven by the data center expansion, and this has created both shortages and also memory price increases. From a supply perspective, given our scale, the relationships we have, the contracts that we have, we are in a good position, but we expect memory prices to increase, and they will mostly have an impact in the second half of the year. In the first half, we are well protected given the inventories on hand that we have, but we expect to see an impact on cost on the second half that we will mitigate both by redesigning our portfolio, lowering memory configuration, looking for additional suppliers, and eventually also increasing prices given the magnitude of the cost that we are expecting.
Yeah, Enrique, I mean, these are serious increases. I mean, how much could a PC go up because of higher memory prices?
Well, we have shared in the call that memories represent between 15 and 18% of the cost of the PC. So you can calculate that the price increases could be significant in the second half if we need to mitigate all through price. But again, we're taking other actions to try to protect demand and try to protect our consumers.
I'm not going to pretend, Enrique, that I work at a Best Buy and I'm a computer geek and I know enough about computers. I know when I press the power, Enrique, it goes on and allows me to do my work. But how do you just mentioned it, how do you redesign a computer or a printer to keep it a profitable thing when memory prices are going up? What do you have to do?
Well, we have a very broad portfolio, and what we need to do is make sure that customers buy the right portfolio for their configuration. And this is something that in the commercial side for our B2B customers, we enable with our workforce experience platform. We have tons of data that we have captured with telemetry, and this is a tool that enables CIOs to monitor what is the performance for the individual customers, so they can really optimize what memory they have, given the work that their employees will be doing, and is the perfect tool for this type of environments where CIOs will have to optimize how much memory they deploy, what configurations they deploy, and we really think can be a very useful tool for them.
From your vantage point, even looking at it from a memory perspective, the AI build out in the United States and even more broadly around the world, does it feel too overheated to you?
I think that in the medium and long term, it is very clear that AI is going to have a very significant impact in how all of us work. And if I think about the different activities that we do in the company, we really think that this is going to be transformational. So from that perspective, medium, long term, I think that we are going to see a huge impact from AI in every activity around us.
You and I have talked a lot in the past, really the past year, about the AI PC. I mean, that time is now. What are some of the clear benefits you see from these AI PCs compared to a prior generation?
Yeah, so first of all, let me share that in Q4, the mix of AI PCs was above 30%. And our original plan when we started on this more than a year ago was 25%. So adoption is going faster than we were expecting. And there are multiple benefits from purely, I would say, hardware-oriented benefits because they have longer battery life. They are more secure because we can build security techniques that we cannot build in other PCs. We are starting to see many ISVs, many software companies taking advantage of the capabilities that these PCs have. And this can be used to process data faster and to really, if companies use the capabilities on the PCs, many of the inferencing will be faster because will be done locally. We also see other companies taking advantage of the capabilities to improve security. For example, CrowdStrike has been taking advantage of that and building specific security features for AI PCs. So we see a lot of momentum with different software companies taking advantage of that. And we think this is just the beginning of a big transformation that will happen because by processing locally, it is more secure, it is cheaper, and it's faster. So these are the three core advantages of AI PCs.
It's that time of year when everybody's hunting doorbusters and bargains, but while you're fighting for half-price air fryers, there is another clearance aisle hiding in plain sight. That's going to be value stocks. And that's what we're digging into on today's Stocks in Translation. Cheap names with real earnings power, showing you how to build your own holiday stock shopping list with the Yahoo Finance data and tools. Let's start with what a value stock is. It's a stock priced low versus its earnings, its assets, or its cash flow, leaving room for upside if expectations improve. Think of it as a good jacket on the sale racket. Nothing wrong with the fabric, it's just maybe out of favor or in the wrong size pile. But if the fundamentals hold up, you're basically paying less than full price for the same underlying business. But every sale rack has its studs. And in the stock market, that is called the classic value trap. Now that is a stock that looks cheap, but keeps falling because their business is deteriorating, and not just because Wall Street sentiment is temporarily negative. Maybe earnings are starting to roll over, maybe the industry is shrinking, or maybe the dividend is about to be cut. On screen, it looks like a steal, but you soon face regret. So be careful, because in stock picking, there are no returns. Now, let's build a shopping list using the Yahoo Finance Screener. You can find a great preset just by searching Yahoo Finance Screener and clicking on Undervalued Growth Stocks. And here we have some of the categories here. Over 100 names are going to pop up in the results. So let's check in on the filters it's using, then we can whittle down that list. So it starts here with a trailing price to equity ratio from 0 to 20. So you're basically paying under $20 for each dollar of last year's profits. It uses the so-called PEG ratio at a setting of below 1, which means that the price is low compared with how fast earnings or profits are growing. It requires earnings per share to be at least 25% above 1 year ago, so we're not buying total laggards. And it limits the baskets to companies listed on the NYSE or the NASDAQ, just the major US exchanges. Now here's the basket that I ended up with, and we're showing year-to-date returns here on this heat map. I took out all the companies under $1 billion in market cap, and I'm looking for companies paying a nice dividend so that you get paid even if the stock price goes nowhere. You can do this by sorting or filtering for forward dividend yield. But always research the dividend situation of a company because too good to be true usually is. When a stock price gets beaten down, the dividend yield goes up, and it can look huge on the screen. Sometimes it's a real doorbuster, sometimes it's a sign that the market expects a dividend cut. Now, let's take a look at two of the bigger names. Take Pfizer here. It looks like a classic value trap, and I'm going to put this on a 5-year so you can see the performance. This is after its stock COVID business fell off a cliff and the stock price dropped. So it's down 3% this year, and the company still pays a hefty dividend around 6 to 7%. But cash flow is tighter as it spends to rebuild the drug pipeline, which is why the PEG looks weak. It's real income today with real questions about longer-term growth. Then let's take a look at Ford here, which is cyclical value, tied to the US economy with a big sticker yield around 5 to 6%. It pays a regular dividend, but profits are under pressure from EV losses and a choppy auto cycle. And also, guidance has come down. Its negative PEG ratio tells you that Wall Street expect earnings to shrink, not to grow. And this is a doorbuster where the yield is real, but the fundamentals, they have to earn it. It's up over 30% this year, but it's still been cut in half from its 2022 all-time highs. So, how do you keep your holiday value basket from turning into a bag of returns? Here is what to watch next, and I got a nice little list here for you. First, you want to watch out for earnings results and guidance. Are the profits still growing, or are they starting to roll over? Then look for dividend changes, hikes, pauses, cuts, because the income line is often the first place stress shows up. Next, check in on your basket and how it's doing versus the S&P 500 or the NASDAQ over time. And finally, watch for changes in interest rate expectations and chatter, because shifts in rates can swing the pendulum between value and growth. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Bitcoin is still below the $90,000 mark as it attempts to recover from a rout that has erased over $1 trillion from the market cap of all crypto assets. And for any crypto investors looking at their balance sheets for year end, there are some tax filing tips to be aware of before you file, especially with the prices having gone down. Joining me in studio, Tyrone Ross, 401 financial principal and founder. Usually we talk to him remotely, so it's a nice little Thanksgiving treat to have Tyrone in the studio with us.
My mom is watching. She should be
happy.
Good.
Hi, Tyrone's mom. So obviously it's been a rough time for crypto. A lot of your clients are heavily invested into crypto. So yes. I guess before we get to the tax stuff, like, have they been calling you worried, or are they sort of crypto native enough that they've become accustomed to volatility?
Yeah, they're punch-drunk crypto hippies, the majority of them. So they're used to the volatility. And what we meet with our clients monthly, so we're having this conversation all year round. And we'll get to this, but yeah, there's tax loss harvesting, but it also could be a good opportunity for folks to tax gain harvest, which is, I got laid off, I have a low income year, right? But I have highly appreciated Bitcoin that may be down this year, but it may be up 500% over the past 5 years. Might be a good time to take that as well. You can take that gain, harvest that gain against lower income this year. So
that's
a lot of different strategies that you can talk about, but it's always, the headline is always tax loss harvesting. Tax gain harvesting could be valuable as well.
Interesting. Okay, so we backed into that, but let's talk about tax loss harvesting, because typically we think of it with more traditional assets, whether it be stocks or even things like real estate, right? That you have tax advantages. So how does it work with crypto? What do people need to know?
So a couple things. One, I think a lot of advisors, CPAs, and investors don't know that there is no wash sale rule, right? So you can harvest that loss like you would a stock, and you can buy it right back.
So in other words, if you on your balance sheet, so to speak, if you have recorded a loss for this year on paper,
yes,
you can actually exit that position, take advantage of that loss, but then re-enter the position right away.
Right away. Now, as we were talking prior, that's not the end of the story. You can, however, there's something called the economic standard doctrine. Again, this is not tax advice, but I did say at a Holiday Inn last night. But I think that what happens there is you can't just be taking advantage of it, buying, selling every 30 seconds. You have to show some type of economic gain that is clearly material for the IRS to accept it. Now, if you don't do that, the penalties are harsh. So it's not as simple as advisors or CPAs saying, oh, there's no wash sale rule, just sell it, buy it right back. You should be aware of and paying attention to the economic standard doctrine. Also, the losses that you do take, you can write off against some stock gains if you have them. If you're holding the Mag 7 and your crypto is down. So it's really important that you're working with an advisor or yourself, keeping good books and records so you can see what your portfolio is doing to take advantage of tax loss harvesting and rebalancing.
How much attention is the IRS paying to crypto holders now versus a year ago or 2 years ago? And is it actually being, given that this administration is pretty friendly to crypto holders,
yeah,
have things changed at all in a positive way?
This administration is friendly to crypto, but they're even friendlier to making money. So next year, 2026, all the exchanges will have to issue a 1099 DA, which is a new rule now where all of the broker dealers and the exchanges have to issue that, basically giving you your gross proceeds of your trades there. Again, gross proceeds is key, not all of your cost basis. So it's not as granular as it will be in 27 when they have to start issuing the cost basis and gain loss if they have it. So I think what investors need to do is make sure that you are doing it yourself. Use some of these software tools, but make sure you're tracking when you buy, when you sell, the different wallets that you have. Also, this is a good time of year, wallet hygiene for all the crypto hippies out there. If you have multiple wallets, look at those transactions. If you have a Coinbase wallet and a Coinbase exchange account, trying to reconcile those. So there's a lot of things that you should try to rush and do before December 31st if you're a crypto investor, especially with it, nosediving here towards the end of the year.
Well, and that brings me to our last point of discussion, which is Thanksgiving's tomorrow. A lot of people are going to be gathered around tables.
Yes.
And some of these people are going to say, listen, Uncle Joe or Uncle Tyrone, you told me to buy crypto last year, and it hasn't worked out so well for me.
Yeah.
What do you have to say for yourself now?
Well, Uncle Tyrone is not going to be in that position because I was telling people to buy a long time ago. But in the event that you are, I think what I would tell people is this. When you go to Disney World or you go to Six Flags and you buy the ticket to go on the roller coaster, you can't tell the person before you get on, all of the dips I went out of, right? I only wanted to go up. You bought the ticket. Volatility is an opportunity, as we were just talking about in crypto. So if you're aware of all the opportunities that you have for now, again, wash sale rule may go away. If you bought and there's a loss, you go, hey, you familiar with tax loss harvesting? Right. So I think volatility is part of it. I think you have to look at this as an asset class that is a volatile teenager. How old, when we were 16, we're very volatile, right? So it's still very early. And I always tell people, if you bought, you should buy with at least a 5-year time horizon, and that will stop you from asking me about it again next Thanksgiving.
A 5-year roller coaster is
5-year roller coaster. That's a long roller coaster ride.
Especially for somebody who doesn't love roller coasters. Making me a little queasy thinking about it. Obviously you do, or you wouldn't be doing what you're doing. Tyrone, great to see you in person.
Thank you so much for
coming in. And that's it for Market Catalyst. Everybody have a fantastic Thanksgiving. There will be more Yahoo Finance coming up, and I'll be back here on Friday for the holiday shortened trading day.